Hey folks, let's work on some common stock transactions. We'll begin with definitions. So, common stock is the first definition. It is shares of ownership in a corporation. So, the common stock account is reported in stockholders' equity. It has a normal credit balance, and you would increase with a credit and decrease with a debit. And along with it, you normally will show a paid in capital account of some sort. And it has many different names. So we'll talk about that as we get there. Okay, par value is something you need to know about. It is the value assigned to one share of stock by the corporate charter, which is one of the first things you file with the Secretary of State for the state you want to become incorporated in. And it's usually set very low. No, you can also have no par value, but with a stated value. So here, the par value did not get assigned by the charter. Instead, you're going to have a stated value that is assigned by the board of directors. You can also have no par value and no stated value, where neither the charter nor the board of directors assigned a value to the stock. And the legal capital is why we need the rules and the definitions for all of the par value, stated value, and no par, no stated value stock. So legal capital is the total amount that is credited to the common stock account. It cannot be taken out of the business. It has typically and historically been there for the protection of the creditors, even though it's not a very big amount. But you cannot pay it out as dividends at all. Okay, so we're going to do 5 different examples of issuing common stock. So the first example, we're going to issue 1,000 shares of $2 par value common stock for $10 per share. So we're going to get cash, $10 times 1,000 shares, $10,000. We're going to put into the common stock account only the par value of $2 per share, which will be $2,000. And then the remaining $8 per share goes into that additional paid-in capital account. In this case, it's additional paid-in capital in excess of par because our stock does have the par value. And it's 10 minus 2, so $8 per share, 8,000. I will pretty typically always abbreviate it as PIC, paid-in capital. And if you're an accounting major, I recommend that you start keeping up with where the paid-in capital comes from, because when you get to intermediate, you're going to have 10 million different sources of where the paid-in capital comes from, and you need to keep those straight. And then excess of par, just to denote that it's in excess of the par value. All right, the second example, we're going to issue the same 1,000 shares of common stock for $2, no, it is $2 stated value stock for $10 per share. So if you'll notice, the accounts are almost identical, the dollar amounts are identical, computations are identical. The only thing that's different is in the paid-in capital account, it states that it is in excess of stated value. So if you have software for your homework, I think it's very important that you make a distinction about when you're using a par value or when you're using a no par but a stated value, because that's going to make a difference in drop-down menus and the choices you have. Third example, we're going to issue another 1,000 shares, no par, no stated value stock for $10 per share. So notice we do not have a paid-in capital account now, because every single penny that is collected is deemed to be legal capital, and it all gets credited to common stock. Okay, so you debit cash, credit common stock for the $10,000, you're good to go. Okay, sometimes when a company starts up a brand new corporation, you don't have a lot of cash, which is why you sell the stock. But even to get organized, you can't necessarily pay for that. So what you're willing to do is you're willing to issue common stock in exchange for either services that someone will render, maybe it's a legal service, or an asset that's other than cash. And when that happens, when you exchange stock for services or assets, then you're going to value that stock at the fair market value of the consideration you received. So if it was a lawyer, it would be the billable time, how many hours they spent, times their billable rate. Or you can use the fair market value of the consideration given up, whichever is more clearly determinable. So that's the rule right there. An actively traded public company stock, you can clearly determine that price. The asking price of an asset that the owner is trying to sell is very negotiable and is not an accurate number ever. The appraised value of an asset, as long as it's by an arm's length third party, would be more clearly determinable than the asking price by the owner. Okay, I hope that was a little bit more clear for you. Okay, so the fourth way, we're going to issue 1,000 shares, $2 par value stock for legal help organizing the corporation. There is no established market price for the stock, and we're going to use the fair value of the attorney's services at $10,000. So that means that their service for 1,000 shares of stock is valued at $10 per share, and it's $10,000. So what we're going to do is we're going to debit organization expense. So since this is the beginning accounting class, that is all we're going to consider. In reality, you can either debit an asset called organization cost and then amortize that asset, or you can debit the expense directly. And all we're going to do in the beginning class of accounting is debit the expense. We credit common stock for the par value, and the excess goes into paid-in capital, just as if you had received cash for it. Okay, so let's receive an asset this time. We're going to get land for 1,000 shares of the $2 par common stock. And now we're going to say that the common stock is actively traded at $10 per share, and the land is advertised for sale for $12,000. So that's what the owner wants to get, but he's cushioned it a bit because he knows he's not going to get $12,000 for it, and he's going to have to negotiate some and come down on the price a bit. So that's why it's a little bit overvalued there. So we're going to debit land for whichever one of these is more clearly determinable, and the active traded stock is the more clearly determinable. So the land goes on at $10,000, common stock for 2, paid in capital in excess of par, $8,000. Same thing again. Okay, so when we finance our company, we finance with debt or equity. So if you finance with debt, you've gone to the bank and borrowed money, and you're going to pay interest on that money. If you issue equity, the people who buy your stock hope that the stock goes up in value and they can sell that stock later on for a profit. Or they're hoping that they're going to get a dividend every year on it. So let's talk about dividends for just a minute. A dividend, if it's cash, is a pro rata, meaning equal piece, cash distribution to stockholders. On the declaration date, the dividend is declared by the board of directors, and a journal entry is made by the company to debit dividends and credit dividends payable for the number of shares times the dividend per share amount. The record date is the date that determines the exact stockholders who will receive the dividend, because after the dividend is declared and before the record date, people still buy and sell stock all year long. So at the record date, all that does is determine who's going to get the dividend, and you do not make a journal entry because you haven't changed the amount of the dividend. The payment date is the date the dividend is paid, and a journal entry is going to be made to debit the payable that you set up earlier and credit cash. And the money is going to go to people who own stock on the record date. Okay, I hope that was helpful to you. Come back again. Bye.